Hello, welcome to Tuesday with Lloyds. My name is Enya, Regional Director and Practice Leader for Risk Management at Lloyds US. Launched last September, Tuesday with Lloyds has been an ongoing dialogue between Lloyds market and our stakeholders in America's region. These sessions provide you with perspectives on the current and emerging risks, an overview of risk transfer solutions available and in progress at Lloyds, as well as updates on future at Lloyds, a multi-year journey towards the most advanced insurance marketplace in the world. Our primary goal is to assist you in keeping connected with market leaders and field experts at Lloyds. Today, it's my great pleasure to present to you the Reinsurance panel featuring Nick Chalk, Active Underwriter, Cincinnati Global Underwriting, Mike Williams, Divisional Director, Crisis Management at Hiscox, and Steve McElhiney, Senior Vice President and Director of Reinsurance at Artex Risk. Before we start, a few housekeeping items. To help you better understand, to serve you, we would like to get a sense of who you are. So please take a moment and answer the poll questions we'll be posting just a minute. We strongly recommend you to ask questions throughout the session to keep a dialogue. Instead of asking in the chat box, please use the Q&A function instead. Today's session is being recorded and streamed live on Lloyd's YouTube channel. So please share with any colleague who is unable to join us today. Without further ado, please welcome our panel. Steve, the floor is yours.
Thank you, Enya. Well, it's my pleasure today to be the moderator of this panel. I've had the opportunity to work with Lloyds for many years, and the two organizations represented on the panel, Cincinnati Financial Syndicate as well as Hiscox, have had a number of dealings with for clients. And so today's presentation, we're not going to really be talking about global property, global casualty, looking at rate changes and so forth, because in many ways, when you're looking at percentage changes in rate, it's an apples and oranges exercise because many factors enter into that. But we're going to be doing more of a drill down into two specific areas. One would be the direct and facultative reinsurance side of Cincinnati Financial with Nick, that's involved with very complex property risk around the world. And then we will talk to Mike, who is with Hiscox in the specialty casualty role, broadly defined with a number of coverage areas that are very innovative. And hopefully today we will have an opportunity to really have a good discussion, answer your questions, and give you a good feel for the sense of the market in those areas. Just as I start out, I would like to just make some high-level comments about excess casualty, broadly defined, both direct and facultative, as well as excess placements that are going into Lloyd's. As to state the obvious, we're in the midst of a sustained hard market for both property and casualty, and my experience with excess casualty has been certainly that case, where we've seen year-over-year increases in rates, some contraction in conditions. Definitely pressure for our clients to retain more risk, and so that's a general theme. Some are doing that through captives, others through SIRs. And I guess when you look at classes of business, there are some particular areas of the broad commercial marketplace that are facing capacity constraints, both for casualty and property, and certainly that's been our experience with certain classes of business. And then when you look at how these programs are rated, oftentimes the buyer will be a little bit chagrined to say, well, I've had loss-free experience on this program, yet I'm seeing a very significant increase. Well, a lot of that's driven by exposure rating, which is in the market. And so increasingly all the reinsurers, Lloyds and all others are looking at emerging exposures and so forth. And that's a key factor in how these covers are rated. And then I guess the final point is we've definitely seen a contraction with lead markets on casualty towers. So there's definitely, you know, sensitivity to where you sit in a program, and frankly the high level excess casualty layers, which I found in recent years were very easy to place, in the most recent cycles have been very difficult to place because of things that you've heard so much about, like social inflation and nuclear verdicts, and certain tort environments in the United States are particularly difficult. So definitely there's been compression of limits on the excess casualty side. So that's just a high-level overview on that segment we wanted to provide to you. But with that, I think it's time to turn to have our initial discussion with Nick on the direct and facultative property side of things. And I think probably the first thing to do, Enya, would be to tee our polling question for that section. Well, first of all, here's our results from the first polling question. So you can see we have a pretty broad distribution of backgrounds here, risk managers, as well as those involved in retail, wholesale distribution, reinsurance broking, and direct underwriting. So this is great. I think we have a very good spread of participants, and so the questions, I imagine, will be varied, and we hope to be able to answer the questions in all those areas. So our next polling questions just come up around the property side about some of the challenges you're experiencing in the market. If you could take a second to indicate there. I think I could definitely say I've experienced all of these things in the most recent couple of years in the current market environment, and so we'll go into those a little bit more into why that's the case. And so go ahead and answer the second question. We'll have those answers up shortly. But I guess as we're waiting for the answers, Nick, why don't we start out a little bit about what you're seeing in the rate and pricing dynamic in the market?
Yeah, thanks, Steve. Yeah, I mean, certainly the market is still hardening. The momentum from 18 and 19 post HIM has continued. It's not necessarily due to a severe lack of capacity, but there's certainly a much reduced appetite across the board and a nervousness of cat losses and risk losses. So we are seeing strong new business still into London. The renewal retention is very high, and our signings are really high as well. So all of those dynamics point to the pricing still continuing upwards, and terms and conditions are very much on the agenda as well. So last year unfortunately was another challenging year. A lot of hurricanes, but amongst that, the headline news, there were more wildfire losses, an event called a derecho or derecho, which I'd never heard of before, and rioting losses as well in the book. So lots of challenges and a lot of perils, which and we look at Texas just now, unfortunately, as well. A lot of events and perils that we're not necessarily pricing for and understanding. So it's been a challenging period, and the market is I've heard talk about pricing adequacy, but I think people are looking back to maybe a time where there was a lot less activity on the loss front than there is now. So I think the market is still pushing, or the market is still pushing for rate. We as my outfit in particular are very much a primary focused underwriter. It's not necessarily just about price, it's also terms and conditions, because in the long soft market prior to 2017, price got eroded heavily, but also forms got very broad, and what would have been smaller losses have been heavily inflated with a lot of coverages which we weren't necessarily keen to include or were not able to price for. So there's a correction on that front too. There's difficult, there's always a difficult class within the DNF space, and I think in recent years that would include habitational business. Food risks have certainly had their moment as well. Coal accounts will have had losses recently, and with Lloyd's new ESG report controlling, the ability of underwriters to take on coal going forward. I think that coal clients might struggle to get capacity full stop, regardless of price. On a positive note, we do feel that attrition's getting a bit of a handle now. We're getting a handle on attrition, so that's something, and we need it. Certainly last year, with all of the CAT events, and I think the PCS claim count was the highest it's been for a while, or certainly as high as it has been in the last 5 years. It's good to see the market getting a handle on attrition, but there still appears to be work to do.
So Nick, what are you seeing in terms of retentions and deductibles? I know they've generally been increasing, but can you speak a little bit about that?
Yeah, I mean, certainly, we very much like to work with our clients individually and not just, have a broad brush approach in terms of rates. So, if retentions are the answer to keep the premium spend down or the same as the year before, then we're very happy to trade that. If we can quantify an increased AOP or a CAT minimum or a CAT percentage going up, then that's certainly the way forward. And we've got a lot of long-term clients, and that's definitely been the way forward. Rather than just seeking price increase. So, and again, not just deductibles, but also sublimits and coverages, full stop.
Yeah, Nick, a question's come in terms of condition restrictions in the current market. From a property standpoint, can you speak a little bit about that with silent cyber and things of that nature?
Yeah, I mean, there was a review in post some big cyber attacks in 2017, which led to Lloyd's mandating that from the 1st of Jan 2020 onwards, underwriters were not silent on cyber anymore. So you had to affirm cover or exclude cover. I mean, the property book's a very traditional book, and the market's been struggling insuring what it's there to insure, the bricks and mortar of the world. And cyber certainly wasn't a peril that the market was there to take on. So it's generally it's excluded really in our world. There are specialist markets out there now who will price it accordingly and give a much more contract certainty, and also much for the client the expertise and assistance on risk management. So that's very much a hot topic, cyber. Strike SRCC following events last year, not just in the US but in Chile, has sort of highlighted that's a peril as well, which some people have looked to take out or at least sublimit to a number which is manageable. But in general, a lot of soft coverages, hospitality accounts, a lot of coverages got very broad over the soft market, and a very small PD loss would often lead to a big loss because of all the add-ons that came with it. So I think the market, very much focused on forms as well.
I guess in terms of clients and buying limits, do you see that they're buying less limit in the current market given higher prices, or maybe speak a little bit about philosophically how clients are buying limit to the MFL, to the PML? I know it varies quite a bit out there, but some of your thoughts on that.
Yeah, it definitely varies a bit. I mean, we have seen people take more risk, whether it's less limit or bigger retentions or co-insurance. We do get it on occasion because the market has uplifted people. There's been compound rate increases. Often, we're quite happy if people take a bigger retention. It's although the market is hardening, we were coming from a very, very low base, and I know we have to treat everybody individually, but obviously, as you referenced at the beginning, the uplift of the market you're generally in the market still, and if you're a good performing account, you expect to be at the lower end of it, and vice versa. Definitely seeing more appetite for insurers to maintain risk. However, events of late it's not an easy world out there, and you know, we will see in the long run how it pans out for people. But you know, with COVID, the impact of COVID, you know, we've seen BI numbers reduce in certain sectors, and I think people maybe have taken that as a chance to look at the limit they buy to, and you know, maybe the limits all of a sudden a bit excessive on the PML or the MFL.
So I guess, you know, given the market, how difficult it is, can you comment a little bit about what makes for a successful placement, you know, in terms of timing and the information you like to see? And I know underwriters generally around the world are inundated with a lot of new business submissions that are coming in, and there's frankly a lot of disruption in the property side with some primary carriers reducing capacity dramatically, and they were 100% on a program, now they're not, or non-renewing, and definitely we see a scramble for capacity, and so I guess as all these submissions come in from brokers and ultimate clients, what in your mind is really what's generates a successful outcome for them?
Yeah, I think you know, it's a couple of issues. I think is that obviously the market is very busy, especially the next sort of few months are really busy. You know, we've worked from home. I think the industry's done really well. Certainly, electronic placement has stepped up and allowed for that to work seamlessly. But in terms of submissions, you know, working from home is not quite the same as being in the office. You know, it is a little bit clunkier, and there's a lot of calls that take up your time. So, you know, triaging of business is very much key. You know, a lot of submissions are coming in, and you really need people to differentiate themselves, and you know, for brokers to give us some good steer or guidance on pricing and terms, because you know, it's very hard to keep revisiting accounts. You know, we appreciate right now is, you know, a decent, honest target, and you know, data is key. So, you know, up-to-date valuations. You know, we're still seeing underinsurance when losses are occurring. You know, but survey reports. You know, if the submission can be early, obviously great, and the fuller the better. So the more information day one, and you know, it's obviously then very much down to the broker to single out the risk and sort of get it to the top of the pile, because it's a busy time, and renewals, there's enough renewals out there, and the new business flow is still very strong. So you know, Lloyds is a good market for considering pretty much everything, but right now you can definitely do yourself a favor by coming out early, and giving us, you know, a pretty good estimate of where life's going and what layers you're looking for.
What's the in terms of loss control reports and engineering, third-party engineering studies? I guess what's the value you see of that? And it seems my experience is markets are looking for much more thorough, robust loss control information than was the case several years ago in the market. So some of your thoughts on that, Nick?
Yeah, I mean, we've certainly seen a lot more business come to London, which is sort of maybe bracketed in the heavy industry occupancies, and engineering is key. You know, it's got to be up to date, you know, by a third party. You know, it's these are difficult classes to write, and you know, a lot of big carriers have re-underwritten their books. You don't see a lot of submissions which don't have a big loss on them somewhere in the last 5 years. Right. You know, it's not been an easy class. So yeah, engineering is key. You know, some consistency in who's doing them is great as well. You know, and we really value the risk management efforts. And you know, I know it's a bit bizarre at the moment having to do team and Zooms call with clients, but you know, historically, you know, we've always supported clients coming to London and meeting them. And hearing from the horse's mouth the efforts they do, and it's very much a key component of what we do in terms of building relationships and trusting the message, because an electronic submission is not, you know, it's great, but we also value, you know, meeting people and looking them in the eye, and hearing all the good work. And you know, we like to differentiate people in the long run and build a relationship. So engineering is key. In-house, third party.
Can you speak a little bit, Nick, about the impact that retro pricing has on your capacity, and I think sometimes that element's a little bit overlooked by people that are not close to reinsurance or to Lloyd's, but a lot of the ultimate capacity is going to be driven by retro capacity and, maybe ILS capacity that's alongside that and so on.
Yeah, I mean, there certainly isn't a lack of reinsurance capacity at the moment. It's not like a post-Katrina type year where, things are really, really difficult. However, reinsurance is not cheap, and it's certainly only going one way in terms of pricing. So, taking on new business with cat exposures is difficult. And unfortunately, often clients come to London in a distressed manner. But if that's because of a big market dislocation, it's difficult for Lloyds in London to digest the business. So, we would always say, keep a toe in London throughout the cycle. We very much, about 20% of our book with insureds we've had for over 15 years. So, and the whole idea being to smooth out the bumps of the cycle. There are occasions where reinsurance is very difficult. I mean, last year, for example, most of the cat losses we've experienced are really net to the direct markets. So, but reinsurance is only still going to go up. I think, COVID is very much out there, and however it pans out, it will be a notable market loss. And reinsurers have picked up some losses, but in our eyes, our retention level is generally a point where we won't recover most of the losses that have occurred in recent years. So, it's not a really bad situation yet at the moment with reinsurers, but I think the development of COVID over the next year or two, or however long it may take, in many different lines could affect how things are going forward.
Thank you. Do we have the polling results for question number 2? Okay, so yeah, you can see there that clearly pricing is the main pain point with the audience, and but really it's a spread. The limit, the capacity, absolutely. I think there's a lot of placements that are going down to the wire. Sometimes some gaps that are very difficult to fill, and so definitely my experience would be everything that's indicated here. I don't know. I guess rate and capacity seem to be the two real hot button issues. I guess, Nick, do you see it getting better in the next year or two, or what will it take for more capital to come in to help ease some of the pressure out there?
There are definitely some new people in our space. I don't think it's material, but there's definitely a few more people, and it's a very cyclical market, as we know, and you will always get new people in a market which people consider to be near its peak, maybe. I think possibly people may have thought that last year, and obviously, it doesn't matter too much what you're charging when you have a year like 2020, and maybe this year isn't starting too great either. So I think it's quite a muted market at the moment. There's capacity there. I don't necessarily think people are crazy to deploy big lines. I think people are quite nervous. So, who knows what the market needs to make money fundamentally. And, there will be new people with no legacy that a lot of us have, which is why the market is where it is. And that, and there's always going to be someone new, but I don't think it's material enough to impact what's happening in terms of the rate and the T&C push, because to think that we get to the sort of zenith of pricing and terms and conditions and then the market starts to deteriorate again would be quite a miserable place to be. So we do need a benign year or two, I think.
Sure. Yeah, we've had a couple of questions come in as respects the COVID and business interruption, and I know it's very much an evolving landscape around the world, and certainly in the U.S. it's an area of a lot of attention, really, in terms of what's covered, what's not. But I guess from where you sit, from a reinsurance standpoint, are you seeing a lot of discussion around COVID BI and what, or do you see maybe some changes as we look ahead in the future for broadening coverage for that, to get a price for it, but to make sure there's more stated coverage perhaps?
I think at the moment, I'm not sure there's much appetite. I mean, it's obviously still a live situation. I think the market, you may see some people do what they did with cyber, which would be to introduce a really small sublimit, but I think it would be so small that it's not really what most big commercial buyers would be looking for. So I think, unfortunately, at the moment, I can't see a COVID. I think that's out of our scope. Some people had specialised coverage in place, and we've certainly paid a small number of accounts. We've also seen losses being withdrawn. I don't think at the moment the market's ready to offer anything material at the moment.
I would agree. And I guess so, not really part of our discussion today, but event cancellation. I know it's been a huge driver of industry losses generally. Things like the Wimbledon cancellation, as small as conferences that had EC coverage. Upwards of 100 billion in losses have gone through the reinsurance and insurance system globally. So definitely COVID has been, I think, a key factor in hardening rates for both property and casualty. And, it's an evolving topic, obviously. I think, event cancellation is pretty cut and dry, but many other aspects are very fluid. And, there's a lot of regulatory challenges in the US for sure, and globally on some of these BI issues as well.
Yeah.
Well, good.
I could add on that if you like, Steve. I mean,
yes.
Just briefly on that element of, call it specialty and contingency, and obviously we'll come on to more in that area. But I think when you look at the industry, and it's very old school to put it this way, but you've got the bricks and mortar largely in the property spaces, and then if it floats, it's on the marine, and in the air, it's in the aerospace, and then you've got the long tail casualty lines. Generally, the other side of things tends to be specialty or crisis management, and that often includes things like recall, contingency, personal accident, terrorism in places, and more sort of new specialty lines. And I think when you look at the reinsurance space and also insurance space, a lot of people have expanded into that sort of specialty niche area over the last minimum 5 years for many reasons, largely because it's often classed as non-correlating. Insurance-linked security funds quite like that. And also it's been an area which has had some innovation and excitement of growth when other parts of the industry which has seen reductions. So you've seen an expansion of people going into that area, and then also now, as Nick rightly puts, you've got that contingency side of things where you've got losses coming, and I would say that some areas are looking at that and going, okay, this wasn't quite what we expected from what is often a relatively small part of a portfolio. You're now getting some of those specialty lines that are actually packaged together. It have had quite a lot of losses. When you think about contingency, you think about travel claims, you think about that side of the market, and I think about the reinsurance space behind that. There's definitely capacity, but I would say it's definitely looked at that and said, okay, well, this is some. I wouldn't say it wasn't quantified, but there's definitely some areas there where people have been a bit shocked by some of the numbers, largely due to COVID.
Yeah, it kind of it's a good segue, Mike, into a question that one of our attendees had about pandemic products of the future. Whether that would be something that's a parametric type thing, or what are your thoughts on that? Do you see, or is it going to be a government backstop? Is that probably the best way for this to work and be efficient in the market? But what are your thoughts on that?
Good question. I think with everything in what we do, it's if you can quantify it, understand it, and aggregate it, you've got an ability to write it. It just depends on whether you're set up for that or not. I think when I look at, call it a pandemic type cover, and what we've seen, I mean, if you sat an underwriter down and said, did you think you'd see such a global event? I think they'd be lying if they said it was going to hit pretty much every country at a similar time. So I think for Lloyds or for a carrier to write such a global exposure would be extremely difficult due to just the fact that it could, as we've seen, it's been a global event, not a regionalized event. So I think it's likely, in my view, to be more of a government-backed pool. And obviously there's lots of discussions ongoing about that. And I think that's probably the way it would go, I think.
Okay, great. So I guess with that, why don't we have the third polling question teed up? This is going to be a segue into Mike's discussion around specialty casualty. So if you could take a moment and answer the question there. And I guess as we're waiting for the answers there, Mike, Hiscox and Mike's unit is very involved in a lot of innovative covers, commercial terrorism, political risk, many others as well, and just K&R, of course. I think it'd be very interesting for the attendees today to go into to some of those and just some of the considerations that go into it. I think it's a fascinating area, and then really some of the innovation that's happening. Sure.
Yeah. I mean, I think there's a broad spectrum there, obviously, but I think it's an area of the market, as I said before, people have sort of got into. You've got to go into it with your eyes wide open. When I think about some of the more traditional lines, say terrorism, we're seeing differences in terrorism. I think there's an expansion or a request for coverage to have more contingent business interruption. People are now looking at political violence and exploring that further. And as Nick said, there's a strike civil commotion market, which is available in a standalone terror space, and also from things like cyber. There's obviously a cyber market. What do we look for? Similar to call it more the property lines. In the same way, I think you've got to find clients that have got that level of risk management. You can't treat one size fits all. And I think when we're trying to assess every risk, whether it's, call it, relatively easy to quantify with a spreadsheet and the values, or whether it's more of a sort of business interruption element or a contingent element, you're trying to understand the client as much as possible. So one of these days when we can sit in front of our clients and actually sort of talk to them about their exposures, that's really the best way to underwrite, in my view. I think what we're seeing a bit from a lot of our clients is the industry evolving from in some ways, people are asking for more of a consultancy type approach, obviously working with our brokers with that, but also using firms like we are connected with Control Risks. And I think when you look at some of the products that are coming up in the future, you've got things like reputational damage being requested. You've got things like we offer a service incident response product, which is, frankly, when you need to pick up that phone and call someone because there's a concern or a problem around your business, you want that phone number to ring. So I think we're seeing more of a consultancy type approach being asked for from clients, which we're happy to work through. As I said, it's not easy to quantify, but hence that's where Lloyds comes to its own, when you're able to sort of sit in front of a risk manager and client and talk about those exposures. So that's kind of what we're seeing.
So in terms of commercial terrorism, Mike, I guess, can you talk a little bit about, some of the customers of the product, what kind of industries they're in, who typically would be buying that, I guess some of the features of the coverage, that might differ and be more thorough than, say, TRIA and so forth. But a little bit about that would be helpful.
Yeah, sure. I mean, obviously from a traditional terrorism product, we see large aggregation areas looking for cover, Rockefeller Center, those sort of areas. They're always going to buy what we'd expect high limits. But then at the same time, we have large amounts of aggregate in those areas. So there's a pinch point on pricing and limit. I would say that the terrorism market, in my view, is almost slightly separate. You've got a traditional terrorism market, as I said, things like hotel chain buying, a standard S&T product, but then we're seeing more people looking for active assailant, or what we class as a malicious attack type product, which includes things like threat and attack from things like, as I said, the nasty side of things, with people people attacking your business or your customers. So we're seeing more of an attritional type product coming out there, which is starting to pick up traction, and not the nicest part, but unfortunately people want cover in place for those events, and they want cover for things like putting their business back into the same place before and after event. So again, links into what I was saying before, it is almost less of a physical damage loss, but more of a, okay, help me get my business back up right. May have a small deductible, but frankly, we want to get back up and running quickly. We may need support with things like, media advertising to get the business back up and going quickly. So quite a different terrorism market from what we've seen traditionally. But in a nutshell, you've kind of got quite a few different types of terrorism, as I suppose, call it 5 years ago, it's probably more just the standard S&T terrorism cover.
Is much of that modeled? I guess I know a couple of vendors have terrorism models, and do you have your own tools as well that you use for terrorism?
Yeah, we do. I think there's obviously agencies out there that most of the market will use. I would say that the sophistication of the models has gone on leaps and bounds. I'm sure many of us underwriters remember the days of grids and almost writing in how much aggregate you've got in an area. I mean, now we do spider diagrams, and you can get right down to very, very small areas where like I said, it's almost that thing. You want to be able to sort of say, well, you're looking at a big blast explosion, and you're looking at sort of, right, how much would that take out from a block? But then the new world, you're also looking at, okay, well, if there's a riot and it's on that road and it's going to go down that road, and you're trying to almost sort of aggregate in a very different way than we probably would have done in the past. So there's quite a few different ways of doing it. But I would say that you kind of got that blend of, right, let's just, how much ag have we got in the area? And then you've also got your own tools. So you're constantly looking at much more granular detail than that.
Are you finding the take-up rate for commercial terrorism, is it increasing over time?
Good question. And probably linked to the sort of specialty lines. I think as Nick said, you've got a market which needs to, frankly, get into more of a profitable place. And so we are seeing that, I would say, more of the specialist lines are sometimes an optional purchase. And I would probably say that less so for more the terrorism space. If you are a large size corporation and you've got critical aggregate zone, I would say it's likely that a bank requirement may well be that you need to buy terrorism cover. That said, when I look at some of the other products in specialty, things like product recall, sometimes some of the contingent space, some of the personal access space, even it may well be that it's a nice to buy, not a requirement. So again, sorry to give a political answer, but we're almost seeing a diversion. There's almost that if I need to buy it and my bank requires it, then yes, I would say the take-up rate is exactly the same. What we'd like to see is people buying more of the other products, but I also understand if you're a risk manager, you need to have budget for that. Now, while these items aren't particularly expensive, they tend to be a fraction of your cat spend. If your cat spend's going up and your budget's a certain number, it's hard to fit that in. So we understand that. What I would say is that I would never scaremonger, but I think we're looking at a world that's going to be pretty challenging out there, from an economic standpoint, and from some pretty unhappy areas. I would say we're pretty likely and are planning for increases in social unrest, and probably quite a different exposure than we're all used to from the past of, while obviously the number one driver to sort of unfortunately hit your loss ratios can be, that big physical damage loss from, say, a hurricane. Largely what we do see now is big exposures on the contingent business interruption side of things. You can manage that through good business continuity planning, through having backup systems, firewalls, all the other things we can handle. But I think we're much more of a BI world these days than we ever have been before. So I would suggest, if you can buy a product that can gives you enough BI cover, contingent cover, consultancy cover, reputational cover, I would seriously consider it, because I hate to say it, but it's going to be pretty scary out there.
So, Enya, do we have the results for the third polling question? Okay, perfect. Yeah, so I guess we're seeing cyber and commercial terrorism would be the highest take-up rate in KNR crime. So, but pretty much a good spread here, and I guess as kind of you would expect coming in. I guess let's talk a little bit about some of these others in more detail. Political risk. I mean, when I look at that, Mike, I just see that the world globally and geopolitically, it's just changing so quickly, right? And so that's the big issue. I would think that areas that are going from, cold to hot, if you will, very quickly, and so it must make the underwriting very difficult. Can you talk a little bit about political risk and how it's underwritten and that sort of thing?
Yeah, sure. I mean, obviously, for those on the call that may not be aware, political risk is a nice coverage to buy, so that you've got protection from a political action which could cause assets to be confiscated, expropriated, seized, and other bad things that can happen, unfortunately, from a political aspect. I think when we look at underwriting it, to be brutally honest, we do the best job we can, but we also work with our other experts. So we use, again, control risks, and we, a bit like you'd have a property survey, we have an updated lifetime information that sort of gives us our view, and I'm working with our experts, advisors around what we think is potentially likely to happen around the world, and then obviously we aggregate and price accordingly. And so, I think it's a purchase that is, as I said, in a world that's looking slightly more unstable in some areas. It's something that we advise people to buy. As I said, the potential spend is not ginormous, but what I would say from an underwriting perspective, you're constantly trying to manage your aggregates. I mean, nobody wants to have that day of a large loss. Obviously, that's none of us as underwriters like those things, but that is what we are here to pay if something happens, and that's what we are trying to underwrite. So my point being is, if you have a client that's got a global asset base, and they may have, let's say, a large number of assets in the Middle East or another part of the globe, we're probably going to find that sort of global client, there's quite a few global clients that have got quite a few assets in that Middle Eastern region, and therefore, what we need to make sure is that we've got the right level of aggregate in that area. If in the event there's a unstable or a change in political fractions, we need to make sure that we haven't got too much assets in one place. So it does tend to be the pricing element comes down to the insured, but also how much aggregate you've got in that area. So you're trying to balance that, really.
Yeah, in terms of kidnap and ransom K&R, I guess can you speak a little bit about that? It's very, to me, a very fascinating cover, and I know it's oftentimes purchased by major corporations and so forth. But who typically is buying that? What are some of the considerations and that sort of thing?
Sure. Well, Hiscox, I have to say, we've got a real global presence on the kidnap ransom side of things. We have hubs in Miami, underwriters in Guernsey, and in London. When I look at the K&R space, I'd say it's quite separate in the fact that you've got private clients, without being too generalistic, families that are concerned. Obviously, nobody talks about what they buy on K&R. It's extremely private. And then you've got the corporate clients, largely that buy, non-executive boards, and also, for whole companies. It's a fantastic cover. We are, again, with control risks, when that horrible day happens, you want to have the phone number to ring in order to get you in the best place possible. We have consultants all over the world, some internal with Hiscox and also with our provider control risks. And yeah, it's I would say we're seeing a very good support and uptake from that part. It's one of those products that I think once you've bought it, you generally keep on buying it. And the other element of what we're doing in the K&R space is we also have a product called Service Incident Response, which I can give much more details to if anybody wants to get in contact with. But that is also around running the contingency of your business. In the event, this is obviously more for corporates as opposed to individual clients, but in the event that you may have a problem, be it ingress, egress, or there's an element of your business which is you've got a concern that you can keep going, we provide a service which helps consult with your client in how to get through that problem, basically, with an indemnification on the back end of it. So yeah, interesting times and changing quite quickly within the K&R space.
Yeah, one of our attendees, Mike, was asking about Latin America in particular as respects terrorism and kidnap and ransom. And I mean, when you look at Central and South America, it's a very varied place. wide, variety of countries with varying levels of risk. But can you speak to that a little bit in terms of the capacity that's available and so forth?
Sure. Yeah. I mean, obviously, as all of us from underwriters, when you're going to underwrite, you want to underwrite in the heart of, where people need cover. And so we have a Miami office, for example, and that really does generally attract most of our KNR and terrorism and SRCC and PV Latin American business. That's sometimes business which doesn't come to London, but it generally tends to be very close to the action, very nimble and able to really pick up what's going on the ground in Latin America. We have a big appetite for that, but I would say that it is you've got to be really close to the action in my view, because it changes quite quickly. As an example, I think the Lloyds market has changed slightly how it aggregates and looks at things like the rioting exposure. I think one of the challenges there is to underwrite differently from a big retail store is obviously very different exposure to a mine up in the hills. They both potentially have SRCC exposure, but I would say that you've got to underwrite accordingly to the peril. So in a nutshell, a really good line of business for us. We like it a lot, but you need to be close to the action in my view, so that you can get a real good feel for what's going on. Frankly, it was hard enough to keep up with what was going on in Brexit in Europe, let alone what's going on with all the Latin American countries politically, and the stability from a political violence, a terrorism, and a kidnap and ransom exposure. To handle all of those levels of varying, frankly, concern, you need to be pretty close to it, I would say.
Okay, thanks. So one of the questions that's come in is just for both Nick and Mike. We've referenced aggregates a little bit in our discussions. A little bit more about that. I guess one of the attendees wanted to have a little bit more background on the topic.
Sorry, Steve. Yeah. In terms of
how it works, and what I guess fundamentally how you would structure an aggregate. And I guess you're seeing more of a push towards aggregates in this market. So comment around that for both you, Nick, and Mike, in your respective books.
Okay. I mean, I can cover it briefly from just very, very generally. I mean, obviously, when you buy things like a property policy, you often will buy, per occurrence basis, one loss. But on various perils, underwriters will ask to aggregate that peril to quantify it to a maximum exposure. So obviously, when you take that per risk, it might be, let's take an example, a hotel chain that is saying it'll have a $1 million per occurrence element of a riot, but they want to aggregate it at 2 million. The most amount of aggregate loss you can have on that policy would be 2 million. That would be from an insured perspective. When you then take that to the next part in the chain from an insurer like ourselves, we're obviously insuring a lot of policies, so we're then adding up that $2 million to what it might well be sort of $200, $300, $400 million of combined aggregate. And then from a reinsurance perspective, obviously, or sometimes slightly different, but people sometimes think it as a retro side of things. You'll then also, we will also lay off some of that exposure to our treaty reinsurers. And so they will often put in aggregate limitations on what they are willing to take. So within that chain, that aggregate is obviously quite an important number. So obviously nobody wants the loss to happen, but what the market is asking for is, what is that total for Hiscox in the event of this happening? What would be your total downside? And how does that work from a insured, insurer, reinsurer? Is part of how the chain works, I would suggest.
Thank you. That's very helpful.
Yeah. I mean, we have to have aggregate limits in place, for when, especially in respect of all the cat business that we take on. And it aggregates up pretty quickly, right? There's a lot of assets on the coast or near a fault line or on a fault line, and we have to obviously bear that in mind. And as Mike just said, we buy reinsurance to, take out the really big events, but what you don't want to be doing obviously is having that big event and going through your reinsurance and then sort of retaining net above that again. So Lloyd's obviously has its own controls as well, but obviously internally you have to set your own, and people have different views on the zones, but you naturally as an underwriter you have to be pessimistic and cautious, otherwise you could come a cropper. So we'll buy reinsurance, but there's a lot more assets being built every day on the coast, so there's obviously you have to be mindful of what you're taking on in any one area.
Yeah, I guess, Nick, to build on that with California earthquake and some of the other earthquake zones, it's been so long since we've had an event. It's really, in many ways, kind of not front of mind, if you will, for a lot of the buyers. And to me, it seems like the potential for a major cat earthquake event could be very significant for the industry. And I know it's heavily modeled and so forth, but what are your thoughts about that in terms of earthquake aggregates and capacity? Yeah.
I hope I don't have to see it, or in my lifetime, Steve. To be honest with you, I mean, obviously the model, is refined quite often, and basically due to events that have happened. And I think in terms of California, we haven't seen that event. So the accuracy of the model, on a per account basis, it's hard to say. And I think, as Mike said earlier about the sort of the CBI nature of the world now, we've seen huge CBI events from earthquakes in sort of pretty random places. So the thought of a California earthquake and the ramifications, across the whole book and to the industry, is pretty scary, I think. And, can't speak for how other people do it, but, I think there's obviously a lot of aggregate out there that people have got on their books. I don't know really. It's a difficult one, but it's obviously not tested like the windstorm models are on a fairly regular basis, because as we see, every windstorm's different. Some are strong winds and some bring surge. Some hang around and just dump rain for days, and some go inland. So I think the accuracy in terms of Calquake, I'm not too sure it's too good.
Yeah. Mike, I guess you'd started out talking about some new innovative products. What do you see as some of the products of the future that broadly defined in some of these areas that you're involved with?
Well, I think we'll have to call it a twist of lime. I think there's lots of elements that we do already. It's trying to find something slightly different that is appealing and needed by the client. So again, I sort of talk about, and I have done that sort of active shooter product morphing to a different type of terrorism cover. I could see more products like that. I think reputational harm is something people are very keen to buy. It's definitely one that Lloyds is trying to sort of take the forefront with, and there are products out there which are up and running. I think it's obviously extremely difficult to manage, but it's definitely doable, and I think the market will move on from that perspective. One of the things that I obviously love about working in Lloyds is we are competing but friends at the same time. So one of the benefits of that is that if a reputational product comes together, which is almost like for some markets probably they probably might not write a huge share of it, but they might write a small share of it. Lloyds obviously excels in that area because a number of us can come together and put our capacity in one slip or one program, and it means that some of the newer products can thrive and actually sort of get off the ground from almost a sort of Lloyds incubator type model. But I would go back to the fact of talking about aggregation. I class it as red-faced underwriting. When that bad day happens, can you sit in front of your board and say, look, the downside is X, and I think we're going to have Y. And I think when I think about some of the newer products, I think they've got a good chance of success, but you still need to know what your downside is, and that's obviously pretty difficult with some of these new products that are so less tangible than what we're obviously used to. So yeah, reputational, consultancy based. I think things more like service incident response, and then things that are existing products, but what I would class as a twist of lime, some slightly different from what we're seeing at the moment. But the one caveat I would just quickly make is that I think we've got a really exciting time, but there's been a change in the reinsurance market, and Nick talked a bit about that sort of that aggregate from the earthquake side of things. I think one of the benefits of COVID has been that the reinsurance market it wants to be very much aligned to the insurance market. So, obviously in that chain, simplistically, you've got, client, broker, insurer, often broker, reinsurer. And I think what COVID has taught a lot of people is that, I think some of the negotiations were around making sure that we're back to back on the right terms, the right clauses. While Lloyds excels itself in being a market that can be innovative and being, bespoke for terms and conditions, I think one of the things that COVID has, rightly so, put a good spotlight on is making sure that you're back to back with your reinsurance panel. So, while I think we can be innovative and offer new products and make sure that we have bespoke terms and conditions for our clients, but what I do think is that, standard terms and conditions that are back to back with reinsurers is right at the forefront of most of the underwriters' minds, I would say, and rightly so. I think nobody wants that day where the insured thinks they've got one cover, the insurer thinks it's slightly different because of a bespokeness, and the reinsurer's got a different view. You want it all to be nicely aligned so that you can get on with paying the claim and moving forward. So I don't think we'll restrict being innovative or being bespoke, but I think we just need to make sure that it's back to back along that whole chain, so there's no nasty surprises.
Yeah, I guess when you look at Lloyd's generally, there's a lot of very interesting innovation things going on with the Lloyd's lab and these algorithm-based syndicates. I guess, what are your thoughts on that future? It sounds very exciting.
Well, yeah, similar to the point previously, I think Lloyd's excels in that area because you almost like a bit like an incubator. You can, it's a subscription model, so everybody can have you can test new products out by arguably doing something which isn't completely annihilate your balance sheet. So I think there's some exciting times ahead. I think the way in which we've now learned to all be in our studies or wherever we are at home and work remotely has sort of led to some things changing. I think the Lloyd's market will evolve as well, as Nick said. I love being in the Lloyd's building and dealing face to face with brokers and meeting clients. But I also think there's an element of almost that door opening up from an online perspective and just lots and lots of submissions coming through. So, my point being is that I think some of these new algorithms, if they are a way to sort of almost arbitrage some of the risks and also make sure you focus on, what your niche area is, I think that is something that could be quite appealing for some markets, because there is a concern that I've got that once you sort of have this hybrid of some people at home, some people business traveling, some people in the office, some people at Lloyd's, it's going to be pretty tough to manage all of that. Where at the moment, while I don't personally love it, it's actually quite efficient to be in one place and be able to get on a Zoom call quite quickly. So if we're not careful, we'll have this huge amount of volume and probably not the resource to match it. So one of the ways I expect some markets to deal with that is almost use algorithms or a different type of placement in order to sort of arbitrage some of those what risks come into you. But personally, the best thing we do in Lloyd's is surplus lines, face-to-face trading. And so I hope we focus on that. But I'm also excited to see how some of these other sort of algorithms work.
Fantastic. And Nick, your final thoughts, I guess, on the future of Lloyd's and, just property underwriting, that sort of thing?
Yeah, I mean, Mike's spot on there. I think, most people in Lloyd's, a large part of it is the trading environment and the face-to-face business. And, a lot of the business that we see is complex and it doesn't just fit in a box. It's not motor insurance. So quite rightly, it does warrant, a lot of involvement and a visit with the client. But, the innovation and what Lloyd's are pushing going forward with, data and whatnot, if it can help us be more efficient and quicker, and ultimately that does feed back to the client, that has to be a good thing. So, we're very much supportive of that and made sure that we've had representatives there. We don't know what the room will be like if and when things open up soon, but we're hopeful that the electronic trading platforms have helped in terms of contract certainty all round. But we still want to shake hands and see people, some old friendly faces, and I think that's the real strong point of Lloyd's, is building relationships and maintaining them through good times and bad.
Well, fantastic. Well, thank you, Nick and Mike and Enya. And so I think with that, we're at the 1 hour point. So I guess we will conclude. Enya, any final points you want to mention?
Thank you so much, Mike, Nick, and Steve, for the very informative session and your insight into market. Thank you, everyone, for being part of this ongoing conversation. Please be sure to join us next Tuesday. We'll feature 5 experts in the technology and sharing economy space. So when our question ends today, a short survey will pop up on your screen. Please take a moment to complete the survey and help us in future programming. And thank you again, everyone. Please stay connected and look forward to seeing you next Tuesday.